Meet Tyler. Tyler has been investing for 14 months. He has never read a balance sheet. He cannot tell you what a price to earnings ratio is. His entire investment thesis, if you can call it that, is vibes and momentum. He buys things that are going up because they are going up. His portfolio consists of 3 AI stocks, 1 crypto token his friend recommended in a Discord server, and something called an inverse volatility ETF that he does not fully understand, but which did really well last month. Tyler's portfolio is up 34% this year. Now meet David. David has a CFA, a Chartered Financial Analyst designation, which requires passing 3 of the most rigorous examinations in finance and takes most people 4 to 5 years to complete. David has spent 15 years analyzing balance sheets, building discounted cash flow models, and studying the behavioral and macroeconomic forces that drive markets. David manages money for a living. He is, by every objective measure, significantly more qualified to invest than Tyler. David's portfolio is up 9% this year. Tyler is beating David by 25 percentage points. And Tyler has never heard of a discounted cash flow model. Tyler thinks P/ES ratio is something to do with PE class. And here is the genuinely disturbing thing. Tyler is not an outlier. Tyler is the norm. In extended bull markets, unsophisticated investors who buy high beta, high momentum, high volatility assets consistently and significantly outperform experienced professionals who build carefully diversified, fundamentally grounded portfolios. This has happened in every major bull market in history. It happened in the dot-com bubble. It happened in the 2020 to 2021 post-pandemic run. It is happening right now. And it happens for reasons that are so logical and so mechanical that once you understand them, you cannot unsee them. So today I want to explain exactly why the dumbest investors always win, and I want to be very specific about the word always, because they don't. They win until they don't. And understanding when that changes is what separates the people who build real wealth from the people who confuse a bull market for personal genius. Let's start with the mechanism, because this is not just vibes. There is a precise mathematical reason why Tyler beats David in a rising market. The key variable is something called beta. Beta is a measure of how volatile a stock is relative to the overall market. If the market goes up 10%, a stock with a beta of 1 goes up roughly 10%. A stock with a beta of 2 goes up roughly 20%. A stock with a beta of 0.5 goes up roughly 5%. High beta means high volatility. High volatility means bigger moves in both directions. And here is the crucial insight. In a bull market, where the overall direction of prices is up, high beta assets don't just match the market. They amplify the market. Every percentage point of market gain is multiplied by the beta coefficient. Tyler's portfolio is full of high beta assets, AI stocks with betas of 1.5, 1.8, 2.0, a crypto token that moves 5% on a slow day, an inverse volatility product that goes up when the market is calm and confident. In a sustained bull market, these assets don't just participate in the rally. They hyper-participate. David's portfolio, meanwhile, is built on fundamentals. Companies with strong balance sheets, reasonable valuations, predictable cash flows. These tend to be lower beta, more stable, more rationally priced. They participate in bull markets. They just don't hyper-participate. This is why David earns 9% while Tyler earns 34%. It has nothing to do with intelligence or skill. It has everything to do with beta. Tyler accidentally built a high beta portfolio because he was attracted to exciting, fast-moving, attention-grabbing assets. And in a rising market, that accidental choice generated returns that look like genius. Now here's where it gets psychologically interesting, because Tyler does not think his returns are the product of beta and luck. Tyler thinks his returns are the product of his investing skill, and this is where the Dunning-Kruger effect enters the picture. The Dunning-Kruger effect is the psychological phenomenon where people with limited knowledge in a domain overestimate their own competence. The less you know, the less you understand the limits of your knowledge, and therefore, the more confident you are. You don't know what you don't know, and that ignorance feels like clarity. In investing, this manifests in a very specific and very dangerous way. In a bull market, almost any strategy works. The rising tide lifts all boats. A monkey throwing darts at a stock listing genuinely outperforms most professional fund managers during sustained upturns. This has been demonstrated empirically, repeatedly, across multiple market cycles. When everything is going up, the person who picks randomly feels like they have skill. The person who picks high beta randomly feels like they have exceptional skill. And the market rewards this feeling. Tyler's account balance goes up. Tyler's confidence goes up. Tyler tells his friends about his portfolio. His friends make similar investments. More money flows into high beta assets. High beta assets go up more. Tyler's portfolio goes up more. Tyler's confidence goes up more. This is the feedback loop that inflates every financial bubble in history. It is not driven by greed alone. It is driven by the completely rational feeling experience of being repeatedly rewarded for a behavior that happens to work during a specific phase of the market cycle. The problem is that the behavior stops working the moment the cycle turns, and the very confidence that was being reinforced during the upswing becomes the reason the crash is so destructive. Because when markets reverse, beta works in the other direction with exactly the same mechanical precision. The stock that went up 40% in a rising market goes down 40% in a falling one. The crypto token that tripled goes to near zero. The inverse volatility product, which does well when markets are calm, absolutely collapses when markets stop being calm. And the Dunning-Kruger investor, who has spent a year or 2 or 3 being reinforced by the market for their genius, does not recognize the reversal for what it is. They buy the dip, because buying the dip worked before. Every pullback in the bull market was an opportunity. Why would this one be different? And then they buy the dip again and again, and by the time they accept that the bull market is actually over, they have converted a paper loss into a very real, very permanent loss by continuing to buy an asset that was in structural decline. This is the until they don't part of the equation. Tyler's 34% gain was real, but if he doesn't understand why he made it, if he attributes it to skill rather than to beta and a rising market, he will not know when to change his behavior. He will ride the beta that made him look like a genius all the way back down and past the starting point. The people who actually build wealth across full market cycles are not the ones who figure out how to pick stocks. They are the ones who understand what phase of the cycle they are in and what behaviors are appropriate for each phase. In a bull market, high beta is rewarded and low beta underperforms. David knows this. David also knows that his job is not to win every phase of the market. His job is to be in a position to compound capital over a full cycle through the bull market and the bear market and the recovery. And low beta, fundamentally grounded portfolios do this better over complete cycles, even though they consistently look like they're losing during the upswing. There's a study that became famous in financial research circles. Fidelity Investments, one of the largest brokerages in the world, looked at which accounts had the best long-term performance. The answer was not the accounts of the most active traders. It was not the accounts of the people who had read the most research. It was the accounts of people who had either forgotten they had the account or were dead. No activity, no rebalancings, no repositioning, just time and compounding, completely undisturbed by the quarterly temptation to do something smarter. The Dunning-Kruger investor does the opposite of this. They act constantly. Every piece of news is a reason to reposition. Every market move is a signal, every Discord server hot tip is an opportunity, and every action has a transaction cost, a tax consequence, and a behavioral cost, the cost of making emotionally driven decisions during the exact periods when patience would compound best. Here is what the data actually shows about active trading. Dalbar, a financial research company, has been tracking the actual returns earned by mutual fund investors versus the stated returns of the funds themselves for decades. The gap is enormous and consistent. The funds return on average 8 to 10% per year over long periods. The investors in those funds earn 4 to 6% per year. The gap exists entirely because investors buy when funds are performing well after the gains and sell when funds are performing badly after the losses. They do the opposite of what compounding requires. Tyler will almost certainly do this. He will ride the bull market, feel like a genius, and then make decisions during the bear market that lock in losses. Not because he's stupid, because he never understood the mechanism that was generating his returns. And without understanding the mechanism, he has no framework for recognizing when that mechanism has reversed. David will underperform Tyler for as long as the bull market lasts. David knows this. It's uncomfortable, but he knows it, because David also knows something Tyler doesn't. Bear markets are when wealth is truly transferred, not just lost, transferred. From the people who confused beta with skill to the people who maintained discipline through the underperformance and had capital available to deploy when assets were genuinely cheap. In 2009, at the bottom of the financial crisis, the S&P 500 was trading at prices that were, by historical valuation standards, genuinely cheap. Price-to-earnings ratios were low. Dividend yields were high. The fundamentals of the underlying businesses had not been permanently destroyed. They were just being temporarily discounted by panic. The people who had maintained cash and quality positions through the preceding bear market could buy those cheap assets. The Tyler equivalent investors of the 2007-2008 cycle, the ones who had ridden high beta assets through the bull market of the mid-2000s, had nothing left to deploy. They had lost most of their capital on the way down and locked in the losses by selling at the bottom. This is the actual story of how wealth accumulates in financial markets. It does not come from picking the right stocks or timing the market correctly or finding the next Tyler-style hot asset. It comes from understanding the cycle, maintaining discipline during the periods when discipline looks like underperformance, and being positioned to act when genuine opportunities appear. Right now, in 2026, in the middle of a recession scare, an oil shock, elevated valuations, and markets that have been rewarding high beta behavior for most of the past decade, the Tyler investors are starting to feel the other side of the beta equation. The same leverage that amplified gains is amplifying losses. Whether this is the beginning of the full reversal or another temporary pullback that rewards dip buyers one more time, nobody knows. That's the honest answer. Timing the exact turn is beyond the capability of any individual investor, professional, or otherwise. But understanding the mechanism, understanding that your returns in a bull market tell you almost nothing about your investing skill and almost everything about your beta, is what separates the people who will compound wealth across this full cycle from the people who will end up exactly where Tyler started, or below it. So I want to hear from you. Are you a Tyler, high beta, high conviction, up big in the bull run, or a David, lower beta, fundamentals focused, watching Tyler and wondering if you're doing something wrong? Drop it in the comments. Because I think the honest answer from most people is that they're somewhere in between and they're not entirely sure which side of the cycle they're on.